Well, good morning, good afternoon, everyone, wherever you are. My name is Brad Bollinger. I'm the publisher of the North Bay Business Journal. Thank you for being with us here this morning for this would be our 20th annual wine industry conference. We're doing it virtually, of course, for the first time. We were to hold our conference back in April, and of course, by early March, we knew that would not be possible, but we weren't going to let this stand in our way of fulfilling our responsibility to keep the industry informed and bringing people together. If we can't do it in person, we can do the next best thing and do it here virtually, and we believe it's important to do it. We would not be here this morning. I want to tell, well, before I go there, I want to say our partners, along with our partners, we put together what we think is a very jam-packed program here for you this morning, beginning with Jon Moramarco to talk about everything from sales in the supermarket to down to the tasting room, so we know really what's going on. And then we're very fortunate here to have Wells Fargo senior economist Sarah House with us to talk about where the economy is going. There's a lot of stuff flying around out here, but you're going to get the real story here this morning. And then we'll close with a panel of our partners who are out there on the ground every day talking to customers and people in the industry, and they're going to tell us what they're hearing. The reason we can offer this free to attendees this morning is because of our partners, and we have almost 600 people registered to be here this morning. I want to thank our underwriters, first of all, who've been with us. Farella Braun has been with us for 20 years. They were our founding underwriter, Farella Braun Martel, Moss Adams, Zepponi Company, and Wells Fargo. If you know someone there, give them a wave, send them a thank you note, whatever you can. Let's all try to find different ways to stay in touch. And then our major sponsors here this morning, American Ag Credit, Bank of Marin, Carl Mackey Power and Ross, Dickinson Peatman and Fogarty, Exchange Bank, G3, Gelati Construction, Napa Valley Vintners, Norby Construction, Pizzeni and Brinker, CPAs, Rabo Agrifinance, Sonoma County Vintners, Sonoma County Wine Growers, Spirited Magazine, which is part of the SMI group of companies. It includes the Business Journal and the Press Democrat, Western Health Advantage, the Wine Industry Network, and Wright Contracting. And then finally, our corporate sponsors, DH Wine Compliance, Interwest Insurance Services, Mechanics Bank, and PGIM Real Estate. So if you know them, drop them a line, say hello, say thank you for making this possible here this morning. So as I mentioned, we're going to start off with Jon Moramarco, who's the managing partner of BW166 LLC, providing advisory services and data intelligence to the beverage alcohol industry. And he's also a partner and the editor of the Gomberg Fredrikson Report, one of the most respected reports in the industry. I like this about Jon in his bio. He began his career in the wine industry at the age of 12 when his father decided he needed to develop a work ethic. He's obviously done that. And the work included weekends and summers in the vineyards, where the typical schedule was 10 to 12 hours per day, 60 to 70 hours a week. He spent a majority of his career in the U.S. wine market, but he's also been responsible for sales and marketing for over 100 wine markets across the globe. We're very lucky to have Jon here with us this morning. And so I'll turn it over to Jon. Once again, thank you for being with us.
Thank you very much, Brad, and good morning to everyone, or good afternoon, or good evening if we have anybody in Europe. I'm going to go ahead and share my screen. And really, the agenda I'd like to talk about a little bit this morning is, throughout my presentation, I'm going to talk a little bit about evolution in the process of natural selection. And the reality is, the wine industry has been evolving globally for millennia in the California since Prohibition, really. I want to put wine in context to total beverage alcohol, and just to ground everybody in how the industry in total moves. I want to talk a little bit about 50 years of evolution in the wine industry, then touch on where we were pre-COVID back in January, February, what we're seeing as the COVID-19 impacts in the wine market, some specific analysis of what we've done with Napa and Sonoma wineries and just what's happened, where their revenue sources are, and I'll touch on who is most impacted by COVID-19. I want to talk about COVID-19 and how it's really going to accelerate evolution in our industry, and then try and project a little bit about what the post-COVID-19 market is going to look like. If you look at total beverage alcohol, this chart is some indices we do for BW166 and looks at total serving index, an LDA population index, and then servings per LDA being the yellow line. And really what it comes down to, if you look at servings per LDA, they've been flat since 1992. We've had kind of serving growth of 1.2% a year, population, legal drinking age population growth of 1.2% a year. And you put those two together, people have been drinking about the same amount year in and year out for 25 years, almost 30 years. I won't get into why we had a pop in per capita consumption back during 3 martini lunches in the 60s and 70s, or how MAD kind of moderated consumption, but a lot of history evolved. And when I talk servings, I'm talking 12 ounces of beer, 5 ounces of wine, and 1.5 ounces of spirits. With Gomberg and Fredrikson BW166, we use a lot of government data, and it includes the list here on the screen: TDB tax paid shipments, California, Washington, Oregon tax paid shipments, individual tax paid data at state level, certain economic data from US government, which I'm sure Sarah uses much more. We also rely on other resources such as Nielsen, IRI, etc. But we try and triangulate what's going on with data, both government sources, independent sources, to get a total view of the marketplace. When you look at the wine market and share of beverage alcohol market, the green line is share of servings. And if you go back to 1960, we only had about 7% of the share of servings of all beverage alcohol. That had grown up to about 10% by 1993, and then post the French paradox, we've kind of migrated up to about 17% by 2018, but we kind of seen a slack in the last couple of years. In terms of consumer expenditures on beverage alcohol, up until the late 70s, it was tracking about the same share, but wine's actually been better at premiumizing than beer or spirits. And so by 93, when we have the French paradox, we were about 16% of consumer spending on beverage alcohol. And today we're tracking about 27%. So wine's been very good at premiumizing, and it's been very good at growing share. You know, in terms of total servings per year, they've only been growing 1.2% a year. Wine has grown for 25 years at 3.4% per year. And basically we've taken share primarily from beer, but people have moved to wine, and it's a great thing. And so we've had a great run. COVID-19 is causing challenges, but I still see the wine industry having a bright future, but it's going to be a lot of work. 50 years of evolution of the wine industry. If you really look back, and I don't know how many people remember that Pillsbury used to be in the wine business with Souverain. Coca-Cola was in it with Taylor and Taylor California Cellars. But you know, you go back and look, and the next chart will explain it a little bit more. But in 1969, 50 years ago, it was the first time that table wines outsold fortified wines. Gamut brands were very popular. It was white wine cocktail. 1976, we have the Judgment of Paris. When you got into the late 70s, early 80s, it was kind of dominated. The growth in the market was Lambrusco and wine coolers before we saw some dips in consumption for wine back in the late 80s. Then we moved to white Zinfandel fighting varietals. In 91, we had the 60 Minutes and the French Paradox, and that kind of drove a lot of growth for us, or it started that growth. You know, we've gone to premium varietals, super premium varietals. We now have over 10,000 wineries in the US, 248 AVAs with 16 pending. And through that time, we've had economic and market volatility. And there have always been winners and losers. There's always been people taking share and losing share. And it's going to continue that way. This is just a quick look at what the market has done since Prohibition. And really, you know, we had some good growth, and we started to develop a table wine business back in the 70s. And the market was growing, and then we actually saw some declines in the mid to late 80s and early 90s. But as I've said, we've had 25 years of growth. But we've seen shifts in how people consume, what they consume. And again, we've had constant evolution in people winning and losing. The pre-COVID situation, and I'm going back to January and February of this year, before everything hit the fan, the industry had benefited from 25 years of volume growth at about 3.4% compound annual growth rate. In retail value, we were premiumizing. People were moving up on what they were purchasing, not necessarily prices of individual items moving up, but people were moving up the value chain. And that actually grew at 6.2% for 25 years. Last 2 years, we've seen a decelerating rate of growth for the industry. It's been roughly 1% in 2018 and 2019. Under $9 retail wines have generally seen declining volumes, with 3-liter premium box being the exception. Over $9 has continued to see growth, but it's the rate has slowed over the last couple of years versus what we were seeing earlier in, from 2013 through 2018. The large 2018 crop has created an excess of supply for the industry, so we were dealing with an excess when we walked into COVID-19. Historically, the industry's had faster growth, and so when we've had excess, we've actually been able to grow our way out of the oversupply. With the slower growth in the industry, it's created more complex problems to deal with the excess that we have right now. And historically, large crops have created more of a problem in the valley rather than the coastal areas. But the 2018 crop appears to have created a bigger issue for the coastal areas than the valley, and I'll touch more on that in terms of impact of COVID-19. There's been talk about wine consumption and commitment by the millennial generation, which has been questioned, and I have a different view on that. And I think coming out of COVID-19, the millennials will be one of our success stories that we'll be talking about 5 years from now. We've had slowing number of visitors to wineries, but really it appears that we've had consistent or growing visitors to wine country. But as wineries have expanded experiences, consumers see fewer wineries per day. And so individual wineries have seen a slowing of numbers, but there's been good tourism, but just a change in that tourism because of consumer experience. And the other thing is, when COVID-19 hit the industry, we had all these significant issues to address, and COVID-19 has exasperated them. This is a bit of an eye chart, but it kind of looks at where the market was at the end of 2019, and I won't go through all the details, but this will be available to you if you want to look at it in detail. Last year, total wine market, imports, domestics, everything was about 407 million cases. And Nielsen, which does a very good job of tracking a piece of the market, was about 45% of that. So it's a indicative part of the market. Consumer spending was 75 billion. Our estimate of supplier revenue was about 32 billion, and supplier margins, gross profit margins, was about 17 billion. I'm referencing this so you have a framework to think about how the industry is going to be impacted through COVID. One thing about Nielsen channels, and I really respect what Nielsen's been doing recently to provide us information for their channels, but Nielsen channels are about 45% of the volume of wine sold in the US, only about 23% of the value. It's a good indicator of large retailers, but not the whole market. And just to put that in perspective, in California today, we have 4,000 plus wineries and probably over 10,000 brands. The top 100 brands from California, not wineries, but brands, represent 70% of all California wine shipped, about 46% of the California retail value, but it's actually 86% of the Nielsen volumes. And so when you look at Nielsen, it's really looking at big brands. If you look at the other 9,900 brands, they only represent roughly 30% of California wine shipped, but over 54% of retail value. And they're only 14% of Nielsen volumes, and 23% of their volumes are sold through Nielsen channels. So the other 76% is not represented through Nielsen channels. So Nielsen tells you a piece of the story, and I look at the wine industry as a great big jigsaw puzzle. And so Nielsen is a piece of the jigsaw puzzle, but you have to understand the rest of it. COVID-19 and our assumptions. We're looking at volume growth on an annual basis for the next few years of 1% per year. And just to put it in context right now, looking at the big total beverage alcohol market, my estimates are beer is going to be down 1% to flat for the year in terms of volume shipments. Wine will be up 1 to 2%, and spirits are going to be up 4 to 5%, and spirits are going to be the big winner this year. And they've been for the past few years. We predict we're going to see a quick exit from recession, which we're going to have 2 negative quarters of GDP change, which indicates a recession. In the third quarter, we're going to bounce out of that. But my own estimates are that even by the end of 2022, the economy may not be back to where it was in gross domestic product versus where it was in December of 2019. So although we'll be out of a recession, it's not going to rebound quickly back to where we were. Unfortunately, we're going to see a number of restaurant closures. And, with almost 400 restaurants that sell wine, there could be 100,000 or more that won't be there when we get through this. Consumer behavior is going to change. In long-term on-premise share of wine consumption, 2019, we estimated at 16% of volume. 3 or 4 years from now, it may still only be 12% of volume just because of closed restaurants and changes of consumer behavior. Consumers are hesitant to travel right now, and I think travel industry is going to be slow to come back. Consumers are becoming more accustomed to dining at home, and I actually think that can be a benefit for the industry, but it's going to change the dynamics of that on-premise, off-premise mix. The market's not going to move to a new normal until we have an effective treatment or a broadly available vaccine. I'm optimistic that we'll see that available late this year, early next year, so by March of 2021, we can start moving towards normal. But for this year, with social distancing and impact on on-premise and tasting rooms, we assume that we'll get back to kind of 50% occupancy in those areas by September. And with recent closures, it may be longer than that. And then if we get a vaccine, we're not going to get back to 100% occupancy in the new normal until at least June of next year or later. So as we look at some numbers, this is kind of the assumptions we're using. Again, another bit of an eye chart, but and you'll be able to get this afterwards if you want to look at it in more detail. But this is kind of our estimates of what's going to happen with where we were in 2019, what we're projecting for 2020 by channel, and kind of some changes, and then where we look at 2021 and 2022 going. In the Nielsen channels, they're going to grow 20% this year, 25%, and rough numbers. But actually, once they lap the volume growth of COVID-19 next March, you're actually going to see declines in Nielsen channels in 2021 and 2022. All other retail channels, which includes large chains like Costco, H-E-B in Texas, some others that don't report to Nielsen. It includes a lot of private label that retailers don't report to Nielsen, and then a host of independent retailers. They're going to see growth this year as well, but not as much as Nielsen because some of them have been closed. Obviously, the on-premise is going to get hit dramatically, and we're projecting about 60% decline. But net in the 3-tier system, 9-liter cases are going to be up about 3%. Consumer spending will be down because of the on-premise. And actually, in the 3-tier system, supplier revenues and margins are going to be up slightly better than they have been the last few years. The tough thing is that wineries have become very reliant on direct consumer sales, whether shipped or carry out. And so we actually see what wineries shipped to consumers could be up 9% this year, 17% in volume, but we're seeing a trade down in price versus normal e-commerce. And so 9% in value and margins. But the carry out, because of closed tasting rooms, we're looking at about 60% declines. So net, wineries are going to lose about 30% of their volume and value of the direct consumer. So net, unfortunately, the industry will be up about 1% in volume, but we unfortunately may be looking at about a 4% decline in supplier revenue and about a 9% decline in the supplier gross profit. Looking at Napa Sonoma wineries, and these are wine companies based in Napa and Sonoma. And these are all the physical and virtual wineries, and there's 2,000 of them in the 2 counties. And really the purpose of this chart is to really look at what share of volume is off-premise, on-premise, or direct-to-consumer by size of winery, and then what share of winery revenue is off-premise, on-premise, or direct-to-consumer. And I don't need to get into a lot of detail, but the reality is the large companies that have large brands that sell in big retailers, they're not highly exposed to that direct-to-consumer market, and they're going to work through this, and their business is going to be hurt, but it's not going to be bad. The challenges will be smaller wineries where they have a lot of exposure to on-premise and direct-to-consumer. They're fighting to recover business. You know, one thing I've seen is that within Nielsen channels, some Napa wineries that have historically allocated much more of their sales to restaurants, we're seeing much higher growth of 60, 70% in Nielsen channels. But everybody is doing their own, taking their own view of how to work through this. And the way I look at it, COVID-19, it's accelerated evolution. I ran companies during 9/11, during the Great Recession, and was actually running a importer distributor in Metro New York through Hurricane Sandy. And COVID-19 is nothing like those other incidents, and it's much more challenging. Companies have needed to react quickly, and some have done better than others. Honestly, cash is king right now. Bigger companies, as I just noted, are better able to weather the storm, but some companies are well positioned to do it too. Honestly, as I look at a business, and for many companies, break even should be considered a success this year. Even if you want growth and everything else, given the situation, if you can break even, it may not be a bad year. Wineries and vendors really need to work together to weather the storm, and people need to remember that people who helped them through this are going to be remembered. People who did not help them through this will be remembered in a different way. And we really need to help our business partners where practical and reasonable. Although, unfortunately, we need to also assess risk. And, we unfortunately will probably have some people that are bad risks as well as good risks. We're going to, for evolution, we're going to learn new ways to do business. And I think for wineries, and especially smaller wineries that have consumers stick with them, we need to think about plans for how are we going to treat those consumers when this is over? How are we going to thank them repeatedly? And how are we going to build relationships out of this that will have long-term benefits for individual wineries? Post-COVID-19 market, I think many companies will get through this period, but unfortunately, there will be some that don't. COVID-19 is forcing us to use technology in new and improved ways, and we need to learn from this and expand on this as we move forward, especially with e-commerce. We're going to need to engage with consumers in innovative ways. I mentioned millennials earlier, and back in 1989, there were 77 million boomers, and the hot categories were wine coolers, Lambrusco, and light beer. 2019, and I apologize for the typo, we had 80 million millennials. In the hot categories are hard seltzer and alternative beverages. I look at the millennials right now where baby boomers were 30 years ago. And, I look at that as an opportunity, not a negative. A challenge we have for the industry is that wine costs twice as much as beer or spirits. And I'm not saying that, and that's on a per serving basis, I'm not saying we need to reduce price, but we need to look at how do we continue to justify the value of our products versus beer and spirits. Looking at Napa Sonoma, companies based on Napa Sonoma from the other chart ship 60 million cases a year, but Napa Sonoma only produces about 25 million cases of wine. It's about 6.2% market share. The LDA population growth is going to slow, so that probably means slower alcohol growth. But when you really think about the wine industry, there's 245 million adults, legal drinking age adults. About 160 million drink alcohol, 100 million drink wine, and 35 million drink 85% of the wine. But when you think about Napa Sonoma only having 6.2% share, you probably only need 6 million Americans, and how do we build that to continue to grow the Napa Sonoma piece? And there's 6 million Americans out there that are going to weather this just fine with high disposable income. But Napa Sonoma just needs to look at how we continue to grow the market of Napa and Sonoma wines with those consumers. And with that, I'll turn it over for other questions. And if you want a little deeper look at the data, with Gomberg and Fredrikson and BW166, we actually have a webinar next week, and you're all welcome to join. And with the deck, you'll see the information where you can join. And Brad, I'll turn it back over to you.
Well, thank you, John. That was really terrific. By the way, you can submit questions via the Q&A tab at the bottom of your screen. And the first one that came in was, what is LDA? And it's legal drinking age adults. So hopefully we answered that one. So thank you again, John. Wow, what a very detailed and deep look at where we're at. So, and I think you're going to hear from Sarah in a minute that, this is kind of a two-tier downturn. There are some households that are still doing quite well. So we need to find out how to reach them. And when you said, people remember who was good to them during this time, I'm reminded of Robert Mondavi used to lend out his tractors or whatever he had to what would be competitors, to just help everyone in the industry. And we know what happened, of course. So, John, a question came in. You said the COVID-19 impact is nothing like 9/11. How do you see it being different? Is it worse, better? Just a way of characterizing that.
Yeah, and I think the duration in the shutdown of the economy is a longer duration, far deeper, far more broadly. 9/11, we were back flying within a month after the Twin Towers went down. And yes, people were reluctant, but we rebounded quickly, and we kind of bonded together and, got over it. It's very hard to bond together when you've been in isolation, or, you can't really get together. You can't do a lot of things. So and you'll see when we get the GDP results. I don't know if Sarah can tell me if it's tomorrow or Friday. This is going to be much deeper drop in GDP than what we saw during the Great Recession or during 9/11 or anything else.
So it's, I like to, instead of shelter in place, I call it shelter in space, because we're all kind of out there, rotating around each other. Good point. It's just hard to get together, but that's why we're here today. So we don't have a lot of time for questions. There's one. Will the video be available? Yes. And the slides? Yes, on our website, northbaybusinessjournal.com. Interesting question here. Can we detangle Sonoma from Napa, or are we tied to the same fate?
I think when you look at average prices, Napa and Sonoma are a little different when you talk an average, but you have wines that are much higher priced in Sonoma than some Napa wines, and obviously some Napa wines much higher priced than Sonoma wines. I look at it that it's not really Napa or Sonoma, it's each individual winery, and it's where do they compete, and then who is the market they're going after, and how do they go after that market. So it's not always Napa or Sonoma, it's not always Pinot Noir, Cabernet, Chardonnay. It's truly looking at who you are, where you compete. And I talked market share earlier. Wherever you're competing, how are you going to take market share?
One more question. Your view of consolidation within the industry. I think in our prep for today, there are people with a lot of cash, a lot of big war chests. What's your view on what might take place?
I think there's going to be continued consolidation, but I look at the industry as continuing some consolidation and fragmentation. When you look at 10,000 wineries today, last year, just to give people a perspective, there were 125,000 label approvals granted by TTB last year, approved by TTB. Yes, consolidation will take place. The bigger buy things, but some of their business is declining, so they're kind of staying and they're kind of treading water by buying things. The people that have good business plans and know who they're talking to and where they want to go, they're going to succeed, and it doesn't matter whether some guys are getting bigger or anything. It's really having a good business plan and knowing where you want to go.
Great. Well, once again, everyone, thank you. I want to thank Jon for being here with us this morning. Again, his slides will be posted to our website, as will this video, so you have a chance to come back and review what he had to say. Thank you again, Jon, for being with us here this morning.
Thank you, Brad. And one other thing, if there's some other questions, I'm happy if you send them to me and I'll give you answers on paper and you can make those available as well.
Great, we will do that. Thank you again, Jon. So thank you, Jon. So next, we're very lucky here to have Sarah House, who is a director and senior economist with Wells Fargo Securities Services. She's coming to us from Charlotte, North Carolina here this morning. She covers the U.S. macroeconomy, including the labor market, inflation trends, and investment trends as well, business investment. She speaks frequently on the economy, has talked to the Wall Street Journal, Bloomberg, National Public Radio. So please join me in welcoming Sarah House here this morning. Thank you, Sarah.
Thank you, everyone. So let me go ahead and get my screen up. So what I'd like to do with you today is share where we see things heading in terms of this economic recovery and really what the recovery will depend on. So we're about 5 months into the pandemic here in the United States, and it's been a wholly unique downturn. So if you think about just the speed of it, so for example, if you look at the Great Recession, it took the official arbiters of recession dates to declare we were in a recession about a year after we entered one. In this case, it only took them 2 months. I think the origination is also pretty unique. So, this wasn't a buildup of debt. This wasn't monetary or fiscal policy tightening. This was a wholly external shock. And because of it, the composition is very different too. So services have been much harder hit than traditional areas that tend to see a bigger downturn, like capital spending or housing, durable goods. And so given that uniqueness, it is an unusually uncertain environment, but nevertheless, we do have to get out our crystal ball. So looking at that, so you can see here our forecast for GDP. So we actually get those numbers out tomorrow morning. So Jon was very close with that. And you can see that when we're discussing this event, so it's been exceptionally quick. So we're looking at 2 quarters of decline here, with the second quarter seeing a historic decline. But already we're beginning to see some of the monthly data show that activity has turned around. Now, that might be cold comfort considering just how steep the decline is. So we're looking at the overall economy probably contracting about 12% in just the first 2 quarters of this year. And that compares to a 4% decline in the Great Recession that took about a year and a half. So the speed and degree is certainly unrivaled. And when you look at over the rest of the year and through 2021, you can see that we see some nice bounce back in terms of growth rates. But in many ways, we had nowhere to go but up, just given how steep the declines were as basically the economy completely shut down at the end of March and April. So even though you're going to get some pretty big numbers in terms of growth rates, and that it might look like that V-shaped recovery that I think a lot of people are trying to ascribe letters to, you're still not anywhere close in terms of level. So if you forget the growth rates, but just where are we in terms of overall activity? So you're going to see that it's going to take a pretty long time to recover. So if you think of a recession, so the recession is technically just the period where the economy is contracting. Like I said, we're probably already over the worst of that. But the recovery, so the part where we're actually trying to get activity just back to where it was in the fourth quarter of 2019, that's going to take a lot longer. So in our forecast, we still have GDP probably about 3% below where it ended 2019, even at the end of 2021. So we haven't officially forecast 2022 yet, but I agree with Jon that it's probably going to take even 2022, maybe beyond that, if you just think what the trend rate of U.S. GDP is and where it is today. Now, this forecast does depend on a number of assumptions. So when it comes to the virus and the response, we don't think we're going to see any widespread lockdowns like we did back in March and April. Instead, it'll probably be more targeted, both in terms of localities, but also in terms of what type of activities can be curtailed. So for example, like we've seen with some of the indoor dining or bars. But we also assume, similar to John's assumptions, that we're going to see a vaccine become available maybe towards the end of this year and then widely distributed or accessible in the first half of next year. Now, you might consider those assumptions maybe a bit optimistic, but one thing that we don't have in this forecast is additional fiscal stimulus, and we think that that's a pretty good area of upside risk to our forecast. So we actually think we'll get some. It's just been hard to kind of calculate, given that the parties are so far apart, what that might look like, and so hard to put an exact dollar value and kind of how that translates. So there is probably some upside risk to this forecast too, in addition to those assumptions about the virus. So bottom line here, the recession will be quick, but the recovery is going to be longer. And for many folks, it'll still probably feel like we're in a recovery, or sorry, in a recession for quite a while yet. Now, what this recovery will depend on is really what I consider three cornerstones. So the first is the virus itself. So just to take a look at where we are with that. So we've seen case counts over the past 6 weeks or so essentially double. Now they've leveled off more recently, so that's an encouraging sign. And there's been some questions over testing, but yes, we've seen testing grow, but the positivity rate has also increased. So that's that right hand. So on that right hand side chart, that's that brown line there where even as we've seen a little bit of a dip more recently, it's still almost twice as high as what it was back in early June. So in other words, the virus is still spreading. And so that's going to be an issue to contend with for some time yet. And as the virus has spread, we've seen that activity has begun to pull back again. So if you look at some of the high frequency data we have, like on visits to retail locations or recreational activities, you can see that not only are they still well below where they were prior to the pandemic, but they've really leveled off over the past month or so. So both nationwide and in California. So we've already seen people respond to this resurgence, and that leveling off actually occurred before we got some of the curtailments to activity, including in California. You can see that flattened back in late June. Similar story in terms of hospitality. So we're seeing a consumer response as not just people are being told to stay home or limit certain activities, but they're doing it themselves as they are concerned about this virus spread. In terms of the labor market, so we're also seeing some stalling there in terms of the high frequency data. So we saw regular initial jobless claims last week actually rose for the first time since March. So that hit about 1.4 million. And when you add in the pandemic unemployment assistance programs, this is for things like gig workers, self-employed, you're still looking at weekly layoffs of a little over 2 million. So we really haven't seen improvement in the labor market over the past month and a half or so. So we're beginning to see some stalling there. And if you look at continuing claims, which is just the number of people who are actually receiving unemployment insurance, and gives you a good idea of basically the level of unemployment, we're about 32 million people still collecting unemployment insurance. So 32 million people out of work. So quite a substantial number there. Now, one of the unique things about this downturn, as I mentioned, is just the composition of the industries that it's hit. So services have been much more impacted this time around than we typically see in a recession. So for example, over the last 3 downturns, you saw services employment decline about an average of 2% compared to about 14% for goods producing industry. So that would be like manufacturing, construction, mining activity. But this time around, it's completely the reverse. So you've seen your services employment are down about 12%, and goods employment is down only about 6%. And if you break it down even more by detailed industry, you can see that really where we've seen the biggest job losses also are the industries that tend to pay the least. And so you've seen this uneven hit to income with really the households that were already in the most precarious financial position. So most likely to already be living paycheck to paycheck have been hit hardest. Or in contrast, some of the industries that already tend to provide higher incomes have been pretty limited in terms of job losses. And so you see a similar pattern play out in terms of spending, where consumers have had to pull back on some of those activities that are done face-to-face and in close personal contact. So overall consumer spending, so technical jargon, what we call personal consumption expenditures, you can see in the blue bar, that's down about 11% since February, so that pre-pandemic period. Now, ordinarily in a recession, you see a big pullback in durable goods. So these are things like autos, your RVs, some of these big ticket, more discretionary items that you can postpone. And in contrast, you tend to see services spending continue on. So this is things like healthcare and housing. So, pretty sizable parts of consumption that don't really move on a dime. Well, not this time around. So you can see from that far right-hand bar, we have services spending down about 15%. And in contrast, you actually have durable goods spending is up about it's up about 0.3%, but it's essentially had that V-shaped recovery. And that's as you have seen some pretty big increases in outlays on things like RVs, like boats, power sports. And so for those households that can't afford to spend and maybe aren't able to travel as much, they are making some pretty big outlays. Now, non-durable goods, that's where wine actually shows up. And this is a bit of a mixed picture. So you have things like clothing and gasoline sales down, 30, 50%. But grocery sales are up about 11%. And according to at least the Commerce Department, you've seen wine sales up about 14%. So a little bit of a mixed picture there, but certainly a difference in terms of those spending patterns. Now, when we look at where spending goes from here, so it's important to note that consumers still have quite a bit of firepower, at least through May, in terms of their ability to spend if they had the opportunity. So we've seen the savings rate jump to all-time highs over these past couple months, in part because consumers have essentially been forced into thrift. So with so much of the economy shut down, they couldn't go out to eat, they couldn't travel even if they wanted to. And so we've seen that saving rate jump. I'd also point out that if you look at where the saving rate was even prior to the pandemic, it was notably higher than what we saw back in the 2000s and even the late 1990s. So the household sector in general went into this in pretty strong shape. But this does hide some of the differences across income categories, where you did see households earning higher incomes saw those incomes increase faster over the prior period. They tend to have higher savings rate, and so that was pushing up the saving rate there. So there are some compositional effects, but bottom line there is, in its entirety, households have still a good degree of spending power, and your upper income households probably have even more firepower. Now, part of the reason that you've seen that savings rate jump so much too is not just that forced thrift, but it's the other thing that the recovery will depend on, and that's fiscal policy. So how much fiscal support that we see here, that we've seen already, and where it goes from here. So it's really hard to overstate just how important some of the initial fiscal policy response has been in terms of shoring up household income. So employee compensation, so how much households are earning from their job, you saw that just tank beginning in March. But when you factor in employee compensation and what households are getting in terms of unemployment insurance and impact payments, which is just the official term for the stimulus checks, you can see that those transfers from the government more than offset the income losses that we saw when 20 million fewer people were in work through May. So we've had a huge fiscal response that has helped improve that spending position of consumers. Now, the problem with that, though, is that some of these were one-offs, like the stimulus check, or only temporary, like the unemployment insurance, the emergency unemployment benefits, which are set to run out this Friday. And just to underscore how important those payments have been, is if you look at what the typical laid off worker is getting in terms of unemployment insurance, and add in those $600 in weekly benefits from the federal government. In 36 states, you're seeing wages, you're seeing that income actually above what income would have been without it. So the replacement rate has been more than 100%. So that leads us to a potential cliff in terms of income and therefore spending here in the coming weeks if we don't get some sort of deal. Now, remind you, it is an election year, in case you've forgotten. And so we think that we'll get either some extension in terms of these benefits, and they won't go away completely, but it is likely that we'll see them cut back to a lower rate now that presumably Congress has had more time to actually do a more targeted approach to these replacements rather than just the blanket $600, which they needed for the sake of time. Now, with that, so if we get a phase 5 stimulus package, which we think we will, it's just hard to know exactly the contours of what it might look like, you're looking at even steeper deficits. So already you've seen a pretty substantial fiscal response, not just in terms of the household size, but with businesses in terms of things like the Paycheck Protection Program. And so they've in total, you've seen the stimulus equal about 13% of GDP, which means that we're looking at some of the biggest deficits we've seen since World War II. And one of the issues we're seeing with this phase 5 deal is that we're starting to get a bit of deficit fatigue. So worried about just how big these deficits have gotten and how fast. Now, I'd say that for now, the size of these deficits aren't all that concerning. And that's because of the help from that third cornerstone, which is monetary policy. So we've seen the Fed has responded very quickly to this crisis. So they took interest rates, the Fed funds rate, all the way back down to 0 in March. They had a meeting that was just a couple days before they did that, didn't even bother waiting for that. And they've also resurrected a lot of the emergency lending programs that they had in the financial crisis, as well as created some new ones and increased their asset purchases. So what that's done, it's driven down interest rates, and it's keeping that debt service manageable in terms of that deficit. But importantly, it's also kept the financial system working and in order, so businesses can also take advantage of some of these lower rates and maybe refinance their debt, freeing up some cash. Same thing with households, like particularly when you look at the housing market. Now, we don't think that this Fed support is going anywhere anytime soon. That's in part because we're not expecting inflation to rear its head for at least a long while. And that's in large part because at the end of the day, this is a demand shock. So with economic output and activity still so far below levels that it was, it doesn't even matter that we've had this huge increase in the money supply if people still aren't out there and spending. So we think inflation is going to continue to run pretty low. Also, just as we've seen inflation expectations sink lower. So the Fed's not having to worry about the inflation side of its mandate in terms of when it might have to remove that stimulus. So they're going to stay easy for a long time. And the other reason why we think that the Fed is in no hurry to remove this support is they're looking at the other side of their mandate, the labor market. So we talked about some of the initial job losses in terms of hitting disproportionately things like leisure and hospitality, other services, which are things like personal care, such as hairdressers or nail salons, that sort of thing. But I think as the pandemic goes on, I think one of the concerns that the Fed is having is that what were temporary layoffs from these temporary closures, that those job losses become permanent. So that workers aren't connected to their employers, and so they're not as engaged, and so it's tougher to get back in. And also that we have potential for spillovers in terms of job losses. So it's not just those customer-facing roles that are closed when, for example, the restaurant temporarily closes, but it's those corporate jobs that we begin to see disappear as you've seen revenues and profits at more depressed levels. And so you have to look for cost cutting really across the board. And so you see companies pull back on capital spending. So that could affect industries like construction, manufacturing that maybe haven't been as directly impacted from this. Same thing with professional services. So things like advertising, consulting work, just companies are trying to conserve cash. And so whereas the hit has been disproportionately in terms of those lower paid workers so far, the risk is that it becomes more widespread and you see the second leg down. But I think the Fed's going to work really hard to avoid that, and they're again going to keep that support for pretty much until as long as it takes. And so they'll continue to provide support. And so then it's just a matter of, okay, where does fiscal policy go from here? And importantly, where does the virus go? So with that, I'll stop and I'll leave just a summary of some key points, and hopefully we have a couple minutes for questions.
Thank you so much, Lee Ann. Very insightful, and it's great to get this really, really solid information. So we have time for a couple of questions. We did get a couple here. How do you see the deficit and interest rates affecting the value of the dollar and exchange rates, which is important, obviously, for wineries that are exporting?
Right. So just given the size of the deficit and really how it's exploded compared to other countries, so that does suggest some downward pressure on the dollar going forward. So we see the dollar depreciating against major currencies, particularly as it looks like other places like Europe has the virus a little bit more under control. But a lot of this will be a country by country comparison, because depending on where your market is and what's happening in their fiscal response and their virus situation.
And I have one about real estate. Sales of homes have done quite well. How does this factor into the economy? A home sale has impact so many layers of the economy that, you're going to redo your floors or whatever. So new furniture, et cetera.
Right. So that's been one of the bright spots. And another area where we've seen furniture spending has been down slightly, but nowhere near like we've seen in terms of some services spending. And you've seen households really benefit by these record low rates, where you've seen refinancing activity reach new highs. Pending home sales are near all-time high or near post-housing best highs as well. And so you do have, again, that kind of upper income segment that owns their homes being able to tap in to those lower rates. But the fact that you haven't seen housing stumble, that does have some spillover effects and ripple effects through those furniture purchases. You need a lot of stuff when you buy a house, whether it's to take care of the yard or just as you're rearranging. So that's been a bright spot through the past couple months.
Great. And then I'll put you on the spot here. This is from an anonymous attendee. What impact would there be on the economy with a change in the presidency?
Yeah, so, obviously big election coming up here in November. And I think it depends in terms of what Congress will look like. I mean, I think it's safe to say, if Biden wins, less friendly for businesses, but maybe you get a little bit more predictability out of his agenda. So that might be an offset there. I'd say even if the Democrats get a clean sweep of Congress, you have to remember that historically, usually, even with one party controlling both the White House and both parts of Congress, is they still only get one major piece of legislation done. So you have to look at what the different policy priorities are, and before you worry about the candidate's wish list.
Great. Well, once again, thank you, Sarah, so much for being with us 2 years in a row, once in person and now virtually. And thank you so much for your work on this. It was a really good presentation, very thorough and impactful. Thank you so much. So next, I'd like to introduce our panel, which comes from our partners in this conference, Wells Fargo, Farella, Moss Adams, and Zepponi. And I'll introduce them alphabetically. Lee Ann Pearce, who's the manager in food and agribusiness advisors and is a senior manager in specialty crops for Wells Fargo Bank. Katherine Phillippakis, who is the chair of Farella Braun's wine industry group. Bill Vyenielo, who's a senior business consultant with Moss Adams he has more than 25 years of working with clients in the wine industry. And then finally, Mario Zepponi is a partner and founder at Zepponi Company. It's a mergers and acquisitions advisory firm. And I want to just thank Mario right at the top here for helping us get Jon and all of you for being such great partners in this conference. And I did get a question that was posed for Sarah, but maybe we'll get to it at the end. Maybe people can think about it. And that's what this is doing to vineyard values. If we get to that at the end, we'll certainly try to do so. So what we did here for our audience is we had a couple of phone calls ahead of time to try to work out some questions, and then we'll have some time at the end for questions from the audience, again, using the Q&A function, if you would, please. So I want to start by asking each of you to just tell us a little bit about yourself and your organization, and then we'll move into the questions. And I'll start with you, Mario.
Hi, thank you, Brad. So as you can imagine, I think we've all been on a lot of Zoom calls these days, but I feel like this is like the mother of all Zoom calls. I don't know how many people are on this call, but anyway, Mario Zepponi, principal at Zepponi Company, and we're a beverage alcohol advisory firm, which means that we deal in spirits, wine, and beer, but wine is definitely our core. My three partners and myself all have steep experience in the wine industry, and we've worked on some of the largest deals in the industry, pretty much worked with every major player in the industry, and we pride ourselves of being the best out there, the largest out there, the most active in the marketplace, and investing in relationships in order to create value.
Great. So I'll go next over to Bill at Moss Adams.
Thank you, Brad. Good morning, everyone. My name is Bill Vyenielo. I'm a senior business consultant to the wine industry and agriculture for Moss Adams. I'm based in Santa Rosa. I'm a Sonoma County native. I grew up outside of Petaluma, working in the agricultural industry, mostly working on dairies and hauling hay and working construction. UC Davis graduate, and for much of my career, I've been involved with running ultra premium wine growing estates in Napa and Sonoma counties. That includes 14 years developing a startup and leading it to a successful, very successful business called Peter Michael Winery. Prior to that, I was an agricultural lender with Farm Credit, where we financed a lot of vineyard and winery operations. And for the last 7 years, I've been part of the Moss Adams wine industry team. And I'm fortunate to work with a lot of smart CPAs that really know tax and audit well. As well as since we have a lot of family operations, we have quite a stable of people that have expertise in business succession planning as it applies to both your business and how that can relate to your personal life and financial planning around that. R&D credits, there's a whole valuation of your business. There's a whole stable of people that I work with that when I'm working with my clients, I focus on what are their needs. And oftentimes I may not have the answer to some of the needs that surface, but I can turn to the expertise in-house to really help connect them with the right people that can really help them. So I guess from my perspective, I look to offer winery owners somebody that they can turn to that has some experience and a track record that can help them navigating through some challenging times like we're facing now. So I'm seeing a lot of requests for help in planning ahead, forecasting, getting help with negotiating with banks, and just trying to prepare their company for the next year and a half, 2 years.
Great. Well, thank you, Bill, for being with us. And Kay, next to you. You're a little bit about yourself and your organization.
Yes, I'm the head of the wine practice at Farella Braun Martel, which is a large general practice law firm with offices in San Francisco and St. Helena, and with a special focus on the wine industry. So we've been representing people in the wine business for almost 50 years now. We've done some of the biggest deals, some of the biggest litigation, and we have a mix of clients, large and small. My own practice is primarily focused on real estate, land use, and business, which I describe as helping people buying, selling, developing, and operating wineries and vineyards.
Thank you for being with us. Good to see you. Lee Ann.
Hi, Lee Ann Pearce, manager of the Food and Ag Industry Advisors for Wells Fargo Bank. I lead a team of industry specialists, and we're located all across North America. My specialty is winery and vineyards. I was a lender for 30 years before I took this position, and about half that time was in a wine specialty practice. And so I cover North America and all areas of the bank for that, kind of like Katherine, through corporate banking, wealth management, our commercial banking, and down to our business banking units. I'm a Cal Poly grad, and I've grown up in agriculture, and specifically my parents had wine grapes when I was young. So like John, I spent my fair share of time hoeing weeds and tying vines and all of that. So happy to be here today.
That's great. Well, thank you, Lee Ann, for being with us. Thank you to all of you. So let's start out, and anyone can jump in here. Reactions to what John said and what Sarah said. Anyone want to start there? I see Kay. Unmute yourself there. There you go.
There we go. I muted myself temporarily. So I was fascinated when I heard Sarah say that consumers had been forced into thrift, which is true. Since we were all stuck in our houses, there wasn't much we could do. But I was surprised by her wine sales up 14% statistic. And based on what John said, I'm curious what types of discretionary spending we're going to see continuing. So if we're all dining at home, as John said, what are we going to be drinking? Is that spirits? Is it wine? Is it hard seltzer? And, how do we direct people to wine?
Yes, exactly. Great question. And really the $64 million question here in front of us. How do we get to those households that are going to be in the market for something? Instead of buying spirits, we want them to buy Napa Sonoma, Central Coast, North Coast wine, right? So anyone else have any reaction to what they had to say? I mean, we know it's very tough out there, and what we're going to try to do with the panel here is hear from what they're hearing on the ground, and then also, maybe some best practices you've seen out there from your clients and acquaintances, and to try to leave people here today with a sense of hope as we go forward, and also with good information to execute on whatever you need to do. So let's start. If no one has any more reactions, then again, if you want to just throw it in here as we go to this next question. From your perspective, tell us what you're seeing in the industry. And again, I'm going to start with Mario.
Yeah, so it's quite odd, right? Because if you were to ask me what's the DNA of a strong wine brand a year ago, I would tell you a year ago it starts with a very strong brand that's on premise, that because that's kind of a badge of quality and of it drives demand to be able to see your wine out there on premise in restaurants, hospitality. And then the second one would be direct to consumer, hospitality at wineries, and to be able to go ahead and cultivate the relationship with the consumer. Well, with this whole downturn, both of those channels have been blown up, and some have been able to adjust better than others. But right now, we're in this pandemic that has triggered this economic downturn, and everyone's trying to find their equilibrium point. And I think that, no surprise, the ones that have been heavily weighted into off-premise have done really well, better than most. And the others are trying to go ahead and adjust on the fly. I think the longer the situation stretches out, I think the question that, the observation that Kay had comes into question is how long will this spike in consumption continue to go up with wine? Because a year ago, we were talking about two things that were happening in the industry. In fact, even in January at the Unified Symposium, it's that we have a flattening of the RON curve. We have a flattening of consumption of wine that has been going on over the last couple years, and then coupled with excess supply of grapes. So as a result, building up a lot of inventory, which is not really a good thing in the wine space. Well, with the pandemic and the shift to off-premise, it's helped absorb a lot of that excess, not all of it, but it's actually helping, to adjust this industry. So the pivot has been really important. And then to go to direct to consumer, we might touch upon a little bit later, but it's interesting because from my world, where we're looking at trying to facilitate transactions, we've seen some tremendous direct to consumer brands, but historically these are illiquid businesses, not because they're not quality businesses, it's because most of the buyer pool that's out there is very three-tier focused, and they don't know how to integrate a direct-to-consumer brand. Well, I think this whole experience that we're going through is going to sensitize a lot of larger wineries and mid-sized wineries as to how they can go ahead and incorporate a strong DTC platform. So,
Right. Thank you, Mario. Just going back to Kay's question, I'll just use myself as an example. I think we're all going through our wine cellar, and at some point, we're going to have to restock it. So who's going to be in my inbox trying to sell me wine? It's probably, I don't think I'm unlike many other wine consumers. So thank you, Mario, for that. So basically, things have kind of been turned on their head. I mean, to get on a great wine list somewhere was like the badge of being an excellent brand, and that has just been, really just not in play right now. So thank you. So I'll go to you next, Bill, and maybe I could throw in that question that came actually after Sarah, was that what's happening with vineyard values right now. Maybe you could touch on that if you don't mind. So next to you, what are you seeing out there?
Well, just to address that question about vineyard values, I was talking yesterday about doing some due diligence on a prospective acquisition, and the feedback I had, this came up, was that we haven't seen a decrease in value yet. It just depends on the duration of this situation. They're seeing prices are maintaining. They're seeing aggressive prices, even competition. If you have a good, healthy vineyard. So a lot of the transactions that are happening now were transactions that have been actually in the works for a long time. Mario probably knows this very well. So there are, I think, in the back of everyone's mind, it's how long will this last? And then if it does last for a long time, the expectation may be that we will see some decline in vineyard values. Because what I am seeing on the short term is a decrease in prices that wineries are paying for grapes, and growers are more open to accepting those lower prices as opposed to leaving their crop unpicked as we're getting closer and closer to harvest. So my advice to some clients in the last week has been, if you have a decent offer, don't expect you're going to see a higher price offer. Take it, and as opposed to letting your crop stay on the vine. I'd say from what I've initially saw in the industry early on in the year, there was a scramble to basically survival strategies of how to get through this year, how to get through the fall, how to get through this year. So there were decisions on staffing, there's communications with employees, there's determining your cash flow projections, it's talk with your banker, don't have surprises for your banker, do your projections and run them out a good year, 2 years. And if it looks like you're going to need money a year from now, start talking to your banker now about it. And in that same vein, think about having really good, accurate records, both on a production side and the financial statement side, because if you're going to be going out to your banker for another loan or going to investors for some injection of cash, the more thorough and accurate your information is, the more readily they're going to be willing to lend you that money and have more confidence in the numbers you're showing them. So what we're seeing lately, besides the wineries that are being most proactive and innovative, it's interesting to watch wineries that adapt to the situation and try new things quickly. Like some people that have never picked up a phone and used the phone as a tool to sell more wine, because we all love getting those phone calls when we're at dinner at night. It's the last thing we want to do is have an interruption from some robocall. But what they're using the phone for is to reach out to their existing customers, the ones they already have relationships with. And we're all home. We're dining at home. We're drinking wine. Wine's still being consumed. It's just being consumed in a different location than on premise. And so they're finding really good reception to people that are reaching out to their customers by wineries, whether it's to sell wine or whether it's just to reach out and talk to them about how are they doing and sharing what they're doing at the winery. to deal with this pandemic. So we are seeing increase in interest in data analytics, virtualization, automation, data analytics, so wineries can better understand the consumer's behavior, study how they're drinking wine, where they're drinking wine, and how best to reach them. So, and they're also seeking information sources. I know, like John's BW166 or Gomberg Fredrikson. I think we're all looking for sources to try to gauge what's happening and how to respond and anticipate what to do and developing strategies going forward. Virtualization, Mario, you mentioned Zoom meetings. We've all been doing Zoom and WebEx meetings, but we've also been seeing virtual tastings. We've been seeing wineries bringing in celebrities. So there's a new a phrase that I've heard called edutainment. So people are at home. We're using visual media here, how to connect with people using that technology. We've seen the internet becoming the central highway or focus for connecting all of us through e-commerce and social media, and then automation in the vineyards and winemaking to deal with labor shortages, and also using technology to measure when to do things at the optimal time, how to improve the quality of the products we're making. So there's been real inroads there. And also with management systems, I'm seeing people want information faster. They want more accurate information because they want to make informed decisions. So, so overall, wineries are seeking and hiring talent or services that have those skills in the data analytics world, virtualization, automation. And sometimes we're seeing those hires from outside of the industry to bring in other knowledge from outside of our industry to help.
Well, thank you, Bill. And the other thing about people being at home is when that wine is delivered, they're at home. So it's not this shuffle, redelivery the next day, leave the tag out on your front porch, that sort of thing. Right. So people are at home, so you can get product to them. So thank you. So next to you, Kay, again, what are you seeing from your perspective?
So I identified 4 different things to mention today. The first, of course, is the concern about hospitality and either doing without customer visits to the winery, or doing them in a very altered way. So you're tasting outside in very limited groups, etc. So in that context, there's the issue of how to connect personally with the customer, which Bill mentioned, which can be by phone, by email, but ways to maximize your existing customer base and keep them loyal, since it's harder to find new customers, although there's also a trend toward additional online marketing for new customers as well. And part of it is focused on trying to develop a new and exciting product, whether that's a special offering or a wine education program or some sort of other online interactive program, but something that feels out of the ordinary and will capture people's attention. And then for wineries that have very high-end wines and may not be selling through all of it, there's an issue of trying to mix up your price levels. So selling some very high-end wines with some lower priced wines, mixed cases, that sort of thing, so that you're still moving all of your product across the board through. And many wineries have been doing this quite successfully. Those that were nimble and jumped on this right away have been doing pretty well. The next thing I see is wineries assessing what level of production is appropriate for 2020 and beyond. So we've already had a number of calls about grape contracts, people who know they're not going to want to take all of the grapes and are looking for strategies to talk to their growers and work out equitable ways of not taking those grapes that won't ruin those relationships or cause hardship to the grower. That's always a good strategy. If you think you're struggling and you're not going to be able to take the grapes, reaching out to your growers early and starting that discussion is always helpful. We got a lot of calls about employee safety issues. I mean, the obvious one is tasting room employees who are interacting with the public there. There's also concern about farm worker safety at Crush because the normal farm worker housing has shown to be a vector for spread of the virus. So that's a concern. And then employee safety for sales teams, because remember, they're used to being on the road, which means airplanes, hotels, restaurants, visiting on-premise locations. Some wineries have had those employees going back out, some have not. That's a tricky issue. And then on the deal market, deals are still in the pipeline. The ones that were in the pipeline before the shutdown are still moving their way along through the system. Mario and I had a large one close the week before everything shut down. But in general, I think that new sales of wineries have slowed down. There are still a lot of buyers looking, and there are still wineries on the market, but those prices are not being discounted, and that means the transactions are going to take longer, which is similar to what we saw in 2008, 2009 in that slowdown cycle, which is the values didn't change dramatically, but the timeframes did.
Great. Thank you, Kay. It was all terrific. The idea of a high-end winery kind of mixing in some, with its high end, some of its other wines, really, really, really smart. So, Lee Ann, to you, again, what are you seeing kind of on the ground today?
We're seeing several things. When I talk to smaller wineries in my area, some of the themes that have already been discussed, right? They're looking at their staffing closely. They've actually been able to replace a good portion of their income from innovative means of delivering their products. So I think that if they can get that income going and they can, be good cost controllers overall, they may survive pretty well. Not as well as they would have before, but, all is not lost. I think we're going to see people start to embrace more ag tech solutions to replace labor going forward, simply because it's going to be hard to get people to come to work maybe in an environment where they don't feel as safe as they used to. And also we're seeing consumers have a flight to comfort. So if you think about the grocery store, in the past, they were hitting the outside of the grocery stores pretty hard. Well, when the pandemic hit, that reversed, and now the center aisles are empty, right? Everybody's buying soup and pantry loading. So when you think about branding, people are turning to brands that they recognize and they feel comfort from in this time. So if you have a well-established brand, I really think that plays in your favor. And overall, to speak to the vineyard value in our area, we've seen some effect of urban refugees. So if it's maybe a vineyard with a nice house and people have been stuck in the city, they are definitely coming up to look for a place to get space for their family. So that's kind of what I'm seeing on the ground right now, Brad.
Very interesting, that concept of flight to comfort. I think we all went through it. In our household, it was Chips Ahoy, which we had not had since we were kids, sort of like, okay. So lots of things like that. In our staff meetings, we share tuna casserole recipes, just to try to get through this. But I think that will continue for a while. Well, listen, thank you, everyone. I'm going to skip ahead because you've all covered some of the innovations you've seen out there and kind of get the road ahead question in before we go to questions from the audience, which, again, you can submit on the Q&A tab at the bottom of your screen. I'm sitting here moderating them. So where are we headed in the next 6 to 12 months? And, again, I'm going to go back to Mario to start us off. You're muted, Mario. Unmute yourself.
That would help. So over the next 6 to 12 months, I think one of the primary things you're going to see is that there's a lot of crowded wine portfolios that wine companies have, whether they're big or small. And I think that you're going to see, we call it in the industry SKU rationalization. What it basically means is eliminating product lines and simplifying it. And Jon Moramarco made a few references to Nielsen. If you take a look at Nielsen and you pull up, any given winery, you'll see that sometimes they have brands you never even heard of. And you look at it, you take a look at the sales they have, and it's typically not anything that's going to move the dial one way or the other. And you ask, well, why do you need those kind of brands in the market? it's not just because of the distractions, it's because of all the consolidation that's been going on with wholesalers and the retailers. And then now you couple it with this complete pressure where you have a breakdown in sales channels. And I think it's going to lead to wineries wanting to be much more efficient in terms of looking at their winning brands and their losing brands, and phasing out their losing brands to make it so they have more attention focused on where they're making money. So I think that's the first thing you're going to see. I think that one thing that kind of probably needs to be stated is that, you know, everyone's a great friend during great times, but it's the tough times where you really find out who your friends are and who your partners are. And I would just say, looking forward for the next 12 months and beyond, this is the time to invest in your partnerships. And those partnerships go not just in terms of just your employees, it goes, that's where it starts, but it goes beyond that. You know, to the extent that you're in a 3-tier system, you need to invest in those partnerships, see how your distributors are doing, your retailers are doing. Sometimes you have limited ability to make any change, but just the fact that you're engaging with them is critically important, because you're saying, you matter to me, and typically what comes around goes around. The other thing that I would add is, I think that when Constellation made the investment in Empathy Wines, you would have thought that this was a multi-billion-dollar acquisition. And it was not. It was a teeny tiny acquisition. It was basically, Empathy Wines was a direct-to-consumer platform. They did about 15,000 cases a year. But what it represented to them is that they need to figure out how to engage with the consumer outside of the traditional 3-tier channel. And we're in an industry, and most industries are like that are copycat. And I will tell you, this has put a spotlight onto DTC brands and DTC platforms. And I think that you're going to see, and I made a reference to this earlier, I think you're going to see that there's going to be a lot more interest in direct-to-consumer brands as well as direct-to-consumer platforms, because what you basically have is a situation right now where you cannot engage the way you comfortably do in the past with the consumer. So how does your brand survive in the marketplace? And if you don't have a social media platform or strategy, if you don't have a wine club that operates separate from a tasting room, you know, all these different things, then you're going to be vulnerable. And I think that what Constellation did is kind of, it was the shot that's heard around the wine industry here. You're going to see a lot of people now double back and figure out, how do I do it? Do I build it? Do I buy it? Do I do both?
Great. Thank you, Mario. I think DTC was, hope I'm getting this, kind of an afterthought in many cases, and now it's forefront. Okay, thank you for that. So over to you, Bill. Again, things you see over the next 6 to 12 months.
Well, I think that we're realizing the value of leadership and how important that is. Just internally within our company, I can really appreciate the fact that our company leadership had developed a strategic plan, and they solicited input from employees. They've been very good about addressing and educating people about how to deal with COVID and how to prevent its spread. So that's been really reassuring, knowing that your leadership is empathetic, they're forward thinking, they're staying informed, and they're helping employees stay, whether it's good news or bad news that you're receiving from them, at least that you're hearing a plan from them. And so it's very reassuring to know that they're staying on top of things. And that's looking forward. They were saying over the next 60 days, 90 days, 3 months, and they're just continuing to keep people updated. So I would just apply that to any company in our industry. Be reminded how important leadership is in providing reassurance and direction to your team, staying in touch with your customers. We are, I think, seeing a shift from how do we get through the rest of the year to a mindset that's how do we get through 2021 and 21 and into 2022. Obviously, as we've heard, scientists are saying that we may have good news about a vaccine, but it's going to take time for that vaccine to be distributed. And until then, we've got a lot of work ahead of us and some challenging times. So I think opportunities that we're seeing, people are going to continue to consume wine. It's just in different locations. We've talked about the home meals. We know that more wine's being consumed outdoors and outdoor activities. So we're seeing some opportunities through innovations in packaging. Canned wines, for example, the smallest category in the industry, but one of the fastest growing. That's a perfect use for a lot of outdoor activities. So if it's safe to be outdoors and in an area that's socially distanced, canned wines fit that bill. We're also seeing boxed wine sales increase pretty dramatically. So that's kind of a view of value wines selling, people being at home. With boxed wine, you have less waste to, as opposed to if there's only two of you and you open up a whole bottle, well, does that carry over to the next night and the night after that? So there are some opportunities for boxed wines, and I've been reading where some wineries in the upper priced wine categories are starting to box their wines and offer them, as opposed to maybe just the lower value wines. You're starting to see some premium priced wines brands looking at boxed wines as a packaging innovation to put out there. Someone mentioned product mixes being changed, looking at the value wine, targeting that category. But also, I'm seeing more people investing and trying to leverage, as I mentioned earlier, data sources and analytics, and trying to get systems that integrate. Instead of having multiple systems, we're trying to find ways to integrate those systems, whether it's replacing them as one that can do multiple things across production and sales and accounting, but trying to integrate the flow of information so they can have better access to info to make informed decisions, and also work more efficiently with needing fewer people to get to the answers that they need. As we know, we're all going to see some pain in the on-premise world. So we may see some changes in consumer behavior down the road where they're become permanent. And with in-home dining, direct delivery being very rapid and quick, like a lot of us has gotten more familiar with how to use Instacart, for example, or things like that, where you can have things quickly delivered to your home. So there's some takeaways I think that the wine industry can apply. With opportunities, I think of wineries that are in a strong financial position to potentially acquire or invest in some of the other wine companies. Mario mentioned consolidation. I think we're going to see definitely some of that. We are seeing prices softening on the grape sales side as well as in the wine sales side. So, but the availability of high quality grapes is on the increase. And we're seeing a lessening of the excess inventory that did start with the 2018 vintage. So I think wineries are in a little better position there to deal with the inventory, but it all, I think, means that you're going to see greater opportunities for consumers to have greater value, greater quality of wine, greater value on pricing. And being that we're all home and dining together, I think that we may be an opportunity to capture a younger generation. They're using their mobile technology. So when we're thinking about what technologies to use, keep that in mind, where they go, how to stay in touch with them on the move. Internally at Moss Adams, we're seeing some opportunities where winery owners or just business owners in general are looking at some decreased valuations of assets. And so they're taking an opportunity to look at succession planning, perhaps making a transition or transfer of assets from their current operation to the next generation. There's estate planning that's related to that. We're seeing a big uptick in. So, and I also think that we're seeing an increase in collaboration across wine, food, travel, and other types of hospitality industries. I'm starting to see wine trips where they're planning a year out, not this fall, not this spring, but a year from now, we're going to have this wine cruise or this event. So people are trying to think ahead and look at things on the other, beyond this, on the other side. And also, I think to Mario's comment about working together with your partners, wineries and growers, a lot of them have been working together for a long time, and we've seen the ups and downs through the industry. It's more important than ever to, I think, understand each other's needs and try to collaborate on how you can work together through the challenges that we collectively face.
Thank you, John. I'm going to turn to you, Kay, again. Take us to 12 months out. Going to close us out here. I'll get to you, Lee Ann, of course.
Yes. So I have two predictions and one recommendation. The first prediction is I think we're going to see a partial end to the grape monoculture. I foresee smaller wineries becoming more like integrated small farms. Partly this is because it adds an additional attraction for visitors when they can visit or even online. It's a different way to relate. Partly I see one possible way forward for smaller wineries as adding food products to their existing lines. We already see this all over wine country with olive oil, but I think we'll see it with other products as well, with a stronger emphasis on health and knowing where your food comes from and buying what's locally sourced. I think we might see, in addition to food products, things like botanical oils and other cosmeceuticals that are linked to products grown on site. So that was prediction number one. The second is a similar one with regard to the real estate market as a whole. I think we're going to see in the wine country, we're going to continue to see what I think of as a return to the homestead. So we're seeing a flight to the wine country from more densely populated urban areas. People want to buy properties with some land, the ability to have gardens, fruit trees, chickens, this sort of idyllic country dream. And in general, what they want are turnkey properties. So they don't want to buy a project. They want something that they can move into and escape from the ills of the world. So I think we'll continue to see strong real estate values throughout wine country. Recommendations. Two of those. One is when you can buy neighboring property, and the second is consider modifying your use permit. So with regard to the first one, I've had 3 calls in the last couple of months. People who've seen neighboring properties come on the market and are interested in acquiring them. In all cases, I have said, absolutely, you must buy them. I've been a practicing wine lawyer for 20 years now, and I've seen a lot of people buy neighboring properties. I've never seen anyone come back to me and say they regret it. I've seen a lot of people who've come back to me and said, I wish I had just bought that property. And I think it's important, if you can make that investment in additional land, you should. And the second is modify your permit. So tasting room restrictions changed a bit to allow outdoor tastings and to change the rules on food and wine pairings. But I think if there are things that you want, if you want to make outdoor improvements, pavilions, that sort of thing, if you want to change your opening hours, if you want to change your marketing plan, this is a good opportunity. Recessions are always a good time to make land use entitlement modifications because the regulators are worried about the economy and they tend to be more liberal than they are in good times. So, and it's just good to invest in the value of what you already own.
Thank you. Over to Lee Ann.
Well, I think there's that old saying, in chaos, there is opportunity. And so, well, certainly we're going to see some casualties from this disruption, which is major. I'm very excited because I feel like businesses are starting to speak to the millennial population and the ones coming behind them, and through technology in ways they didn't before, sort of what Mario was saying, that they're embracing these direct consumer pathways that will really speak to that generation. So I'm excited to see where we come out of this at the end of the day. I believe there'll be innovation all around and that it's going to look different than we may have expected. I agree with Kay that people are seeking that self-sustaining lifestyle. And I believe that they're also looking at these companies they do business with, and they're looking at their own values. So, if you can tell your story on your label or your website, that you're sustainable, that you care about things that your consumers care about, I think that will really speak to them going forward. So we will have some pain, but I think we will end up stronger at the end of this. That's my prediction.
Listen, I understand I'm having a little trouble with my audio, so I won't drag this out. I'll speak as clearly as I can. I want to thank Mario and Bill and Kay for being with us, and Lee Ann. We have your questions here. We are out of time, but we will make sure that they get them, and perhaps I can answer them offline. And again, this will be up on our website along with our PowerPoints. I want to thank our underwriters, Farella Braun Martel, Moss Adams, Wells Fargo, Zepponi Company, and of course our other sponsors, American Ag Credit, Bank Marin, Carmacky Power and Ross, Dickinson Peatman and Fogarty, Exchange Bank, G3, Gelati Construction, Napa Valley Ventures, Norby Construction, Spirited Magazine, Western Health Advantage, Wine Industry Network, White Contracting, DH Wine Compliance, Interwest Insurance, Mechanics Bank, and PGIM Real Estate. I want to thank you for being with us. We're planning maybe to be back again in the fall with another conference. I want to thank everyone for participating. And good luck to everybody. Stay safe, 6 feet, and a mask, okay? All right, see you soon.